back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in Landon Swan. He's a co-founder at Lightfolio. Welcome back to the show, Landon.
Thanks for having me.
All right, so DocuSign, we talk about this one about every quarter, every 6 months or so. Had a good run in during the pandemic. You needed it. It seems like they've got decent growth numbers, Landon. Competition coming in from some other players in this space as far as e-signature business. But, I mean, they've got growth. They've got free cash flow, but the stock just can't seem to get any traction.
Yeah, I mean, if you look at what happened last quarter, they reported a great quarter. I mean, they had 7.2 in revenue, plus 13% in billings. They're doing everything right. I mean, they're reducing their workforce while increasing revenue. So they're cutting costs, increasing expenses, increasing revenue. It's a great combination, and the stock responded very well. They were about just under 54 right before they reported. Over the next week or so, they ran up to 61, kind of stayed there. Now they're back down to basically 54 again. So I think this is kind of an opportunity for investors that, you've got good news that shows that they're going in the right direction, but the price maybe isn't as reflective of that as it could be. All the data from Lightfolio is fairly positive. Demand is very strong. Web visits are up about 6% on a year-over-year basis. They're getting new and existing customers onto large multi-year contracts. And what I really like is that they've got this Lexicon acquisition, which is an AI company. They're using AI to really power what they're doing, which is a must, right? In their business, AI is very good at words. It's not great at numbers yet, which to me is shocking. But that's the way it's going the reverse way I would have thought it would. But it's great with words, which is documents and agreements. So they have to get ahead of the AI competition, and they are. They made that acquisition, and now they're using AI to power a lot of their platforms. So that allows them to reduce their workforce, like I said, by about 6%. I think that number is just going to continue to climb as they continue to integrate AI. And so with the lead that they've got and the clear ability to leverage this technology, I think it's a safe bet that they're going to continue to be the leader. There will be competition. There's going to be easy, free to use solutions. But if you're a large company and you want to make sure you're getting legal documents correct, you're going to go with a company like this. And if you're, a one-time user, a very small company, maybe you play around with some of the free tools, but enterprise solution wise, you want to sign with a large company. And the fact that they're kind of owning AI as opposed to competing against it is a great sign for this company.
Yeah, Landon, intelligent agreement management is what they call it now that they've got AI helping them. And, if you look at the 3-year numbers, they're horrible. Stock down 77%. But if you look at the 6-month numbers, the stock's up 15%. It's actually pretty solid. So they seem to have found their place where the value is okay, and investors think the value is okay. And when they bought Lexion, you know what they did? They paid $165 million in cash for it. Why? Because they've got a big cash balance and they create a bunch of free cash flow. So this is a healthy company that it's almost like don't look at that 3-year chart because it looks so horrible. But this is a company that, like you mentioned, last earnings, pretty solid move. It's come back down. All things considered, pretty healthy company doing a good job, and now bringing AI into the fold.
Yeah, exactly. And I love how you say don't look at the 3-year chart and then you put it up.
It's horrible. Yeah. Thank you.
Go to the 1 year. Go to the 1 year.
Yeah.
You're right, though. That is a nasty looking chart. But the recent move is very suggestive that, the good news was priced in for a little bit. Now it's priced out. I think there were some talks about potential takeover from a private sector, and they're putting those to rest. And I think that's great for investors because it shows you that there's smart money out there that want to own this company. They want to own all of it. They can't. So they're going to have to buy shares if they want to own a piece of it. You've also got the potential for interest rates to come down. If that happens, then there's going to be a lot of refinancing going on in mortgages and things like that. And there's always, the normal business activity. And this is a high margin business. I mean, they're basically selling software. I think the variable margins are probably probably close to 100%. Every new customer is, is just after you get past customer acquisition costs, serving the customer is just, it's computer chips. It doesn't cost a lot of money to serve them. So it's sales, acquiring the customers and then keeping them. So, as that intelligent software comes online and they can continue to reduce the workforce, I think that their margins are going to keep going up. So I do like this one long term. It's, initially I was a little bit scared of AI because I've seen what AI can do with language. It's incredible. But as long as they're taking advantage and that will allow them to keep the lead that they've earned. So it's funny to think about this coming. Like it's kind of similar to Zoom. Like they had that pandemic boom. Everything's going to go online, and then they sold off. But I think this is a very solid company here, and the price is attractive, right? 54 before the last very good earnings. 54 going into this earnings. I say let's hit it. I like this one.
All right, Landon, I looked at some of the data that you had, the 6% gain year over year on the web visits, positive, right? But then they've got competition, Dropbox, Adobe, and other, companies in the software space that could probably integrate something like this into their own offering, right? Is that a concern for this company moving forward? And is it a takeover target for, moving forward?
Yeah, I mean, the takeover target is generally almost always going to be positive for investors. So hopefully that continues to be a look. But yeah, I mean, you're going to have competition. And again, I think the biggest threat is AI competition. They are utilizing it. They made that acquisition with cash, as Kevin pointed out. And so they're going to take what they've got. They're going to continue to push forward. And there will be other companies that, try to take a bite out of them. It's, that's capitalism. But they've got a great lead. And they're doing really well. Their numbers are strong. Their margins are very, very high. So I like this company here. It's not it's not one of my favorites, but you're talking about an earnings play. I think it's in a good position. If we were talking, if it was trading in the mid 60s, I'd say maybe not, but mid 50s, I think it makes sense.
All right, and earnings score going into this one, because it seems like it's got resistance at that 65 level over the last year.
Right. That's kind of why I picked that number. But yeah, we're at plus 23 right now. So it's not like a slam dunk, but it's definitely leaning to a positive side enough to make a trade.
All right. Great stuff. Great data as always, Landon. Appreciate it.
Thank you.
All right. That's Landon Swan, co-founder at Like